My taxes are so high already. Why do I need to do anything and pay taxes early?
The Wealth Advocates simplify the financial world and show you how today's events could affect your financial health so you feel confident about your financial future.
Good afternoon, Wealth Advocates Nation. Great to be back with you. I'm here with my buddy John Mickelson. I'm Patrick Jenkins. We are here to talk about the Tax Cuts Jobs Act. You know, this was it's often called the Trump tax cuts. It was introduced in 2018. And the big deal here is it took our standard deductions and it doubled them. And it then indexed them. So the opportunity there is people who normally did not have any tax deductions, and these are often those that the kids have left the house. Maybe they have a little bit of interest left on their mortgage. They didn't have any tax opportunities, especially if they work for somebody else. They don't own their own company. So this was a way, or it was projected as a way for the middle class to enjoy some tax deductions.
Yeah.
Right?
Yep. So in a lot of ways, the way I define it for an individual is think about when you earn $1. When you earn money, the first block of money is free of tax. That's the standard deduction. And every person gets, 13,000, a couple gets about 26. So you have to think the first 26,000 you earn is zero, no taxes. Then we move to a 10% bracket. Then we move to a 12% bracket. Then we move to a 22%. So you kind of progressively move up. And so when people look at their real rate of tax, you have to blend all of those. And so that has a big effect if you have that first block at zero.
Mm-hmm. Now, to understand the Tax Cuts Jobs Act, you have to understand how the bill was passed. In Congress, there is an Office of Budgets that comes through and audits a tax law proposal and the impact on the economy. And the way they made this work and the way it passed that official audit by the Office of Budgets is they put a sunset provision on it. A sunset provision is just such a romantic, delightful way of saying your taxes are going to go up. We're going to take.
You have a deadline.
So we have a deadline. When is it?
End of 2025.
Yeah,
early
so
2026. Yeah.
2026, we revert to that 2017 tax code. Now it's indexed forward a little bit, but it means our standard deductions cut in half. It also has an impact on our estate tax. Our estate tax had grown in 2017 all the way to $7 million. It indexes as well. So two things that are going on. Standard deduction today, which is 2024, is $13.6 million for a couple per person. So that's almost $27 million is tax-free when you die and goes to your heirs. The second thing is the estate tax exemption. That was the $7 million. It's now $14 million for a couple. So those two things happening together gave us this window of opportunity that is now closing. Mm-hmm. What should we be doing?
So a big part of this is when we talk about sunset, what we're saying is the whole law will disappear and revert back to the way it was. So if we revert back to the 7 million, the question is right now, while we have 14, is there anything we can do? Now, some of this depends on what happens. And a big part of that answer is what happens in 32 days. Mm-hmm. So we're going to have an election. And there's a major difference between the two parties and how they will want to treat this.
To a degree, I mean, Congress really couldn't enact or extend anything in a short period of time.
Yeah, that's correct. And it's important to make a note of, I think people are very focused on the presidential election, when in reality, these laws and these impacts are held in Congress. Congress, that's the election we should be paying attention to. A lot of that will happen there. And the question is, will they take elements of this existing law that exists right now and make them permanent, or will they let them disappear and have it revert back? Which, by the way, with the need for more tax revenue, there's a big incentive to let them go away.
Yep. So that is one of the reasons why it does have a sunset provision on it, because financially the budget doesn't work at all under these tax codes.
And remember that if they let it disappear and the tax rates go up, who's to blame?
Yep.
There's no one to blame. It's just the way it was. There's nothing we can do about it.
To it. But, so there are a bunch of things we ought to be doing. One of the things we ought to be doing is looking at our existing tax brackets. I think people in their mind intuitively believe I'm paying way too much in taxes. Maybe they are, but as a relative metric to their earning, they're probably not.
No, it's relatively low, historically very low compared to where we've been.
So if your taxes are low, what should you do?
We should be looking for paying low taxes as low as we can make them and getting them over with. And what I mean by that, especially with the idea of converting Roth or IRA to Roth IRA, we should be looking at that very, very closely right now. Anything that can be paid at a lower rate, I tell everybody your retirement plans are like a house with a mortgage. What's your mortgage? Taxes. I want a 10% mortgage, not a 30 or 40% mortgage.
Right. And so there is a funny thing that happens about Roth conversions. People have been pre-trained to think about their taxes just in the short term. Just how much can I reduce my taxes this year?
Yeah.
If you have artificially low taxes this year, maybe we ought to take that next step and say, your retirement account, the government owns as much as 30% of that. If it's $1 million, you'll probably end up paying $300,000 in taxes. And there are timestamps when you have to pay some of that taxes, beginning at age 73. It might be 75 for some of our listeners here.
Mm-hmm.
They have to pull out so much money because, frankly, the government's tired of you deferring your 401k or your IRA growth and not paying your taxes on it.
Yeah.
So they force you to take some out, as much as 5% every single year.
Mm-hmm.
If we take that methodology in mind, we know that we have to pay the taxes on it someday. What if that someday is today? And that's the Roth conversion concept right there. We say, you know what, we're going to take a chunk of this and create some tax-free income with some of these outlying rules in mind, which is, one, I have to pay my taxes.
Mm.
Two, I know intuitively, not factually, but intuitively, taxes are going to go up because we don't have enough budget for all the things that Congress is spending money on.
Mm-hmm.
With those two things in mind, paying at a lower rate seems like a great idea, and having more money in Roth, correct?
Yes. Yeah. Anything that can be created, because think about it in terms of your timeline and your planning.
Mm-hmm.
If you say, okay, I can somehow get money into that Roth IRA and pay the tax currently at a relatively low rate, which that's a very broad term for a lot of people. If you can do that, when you hit retirement, if you have that two buckets, these are different buckets than we said before. This is an after-tax bucket and a pre-tax bucket. So then I can say, in my traditional retirement account, I know I have to pay tax on that, but my Roth, I don't. Then when I hit retirement, then I can say, well, where are taxes now? Are they higher, lower, or are they the same? It doesn't matter. I can say, where is the optimal place to pay the tax? And I take that from my traditional account and stop. And any income I need above that, I take tax-free. In other words, I am choosing my tax bracket. I'm not forced into it.
So let's talk about just a couple of moves to keep things going forward for estates. The first one we already talked about was we ought to consider a Roth IRA conversion.
Yeah.
Should we consider gifting? Gifting is a little different. It's not directly responsible by the Tax Cuts and Jobs Act, but it is indexed. What's gifting right now?
Yeah, definitely. Gifting is a big advantage. It's around $14,000 per person per year.
$18,000 this year.
18, excuse me.
18 this year.
And it's a use it or lose it. I mean, so if you don't use it, it's gone. Now, the one we referred to before is the one time, and it can be used throughout your lifetime, or you can use it when you pass away. But the year by year, it's every year, and if I don't use it, I don't use it. So as you look at where do I want my funds to go and when, sometimes estate planning is maybe charities or family need it now, not later. Mm-hmm. And so that's a big part of, when you look at the dynamics of every family is unique and different. And I always say almost a little weird, but you want to be able to say, how do I create blessings for my family and not curse? Because money can be both. So, how you use your money can really direct and help in so many ways if it's done effectively. That gifting rule is really a tool to use if you're thinking there are opportunities now.
So other things that we might be considering, especially if there's windfalls or medical expenses, we've talked about the standard deduction, but we really haven't talked about itemizing. Standard deduction being so large that a lot of families don't need to itemize anymore like they used to, but there's still opportunities for itemizing. Yeah. And that might be bunching medical expenses. That might be bunching charitable giving. When would we do those kind of things?
Yeah. And what you said is true. And what it is seeing, are there enough of the itemized that we could take a year and another year and roll them all into one? Mm-hmm. And that's called bunching deductions. But we could do that. The other thing you can add on to that is the use of a donor advised fund. Donor advised fund is simply an account When I put money in, it's saying I put money in there and I intend to give it away at some time in the future. I can't take it back. I'm going to donate it. But it's my ability to say, I want the deduction now, even though I'm going to give it away in years to come. And that way you can bunch even more deductions in 1 year. Then you can itemize. And then in a second year, you just take your standard deduction. And it's a way to try to maximize what you can get out of the tax deductions that you have. And that's an individual thing. Some people it will work, some people it won't. And that's where a good accountant, and a good financial planner can make a lot of things work.
Okay, so just a few more months left of the Tax Cut Jobs Act. Any last things we should do in this final year of it?
Make sure you're planning for year end. There are deadlines, and we have now, 2.5, 3 months left. There are a lot of things we can do now that will impact not only this year, but the coming years. So that's where it's worthwhile to come in and look at the broader picture and make sure you're looking at every way you can go that will give you an advantage.
A couple more months left of 2024 and 2025, and that is the end of the Tax Cut Jobs Act. Taxes are going to revert to what they were before. Let's talk about what that impact is on you and your estate. Have a great day.
Wealth Advocates is an SEC-registered investment advisor. SEC registration does not constitute an endorsement of Wealth Advocates by the SEC, nor does it indicate that Wealth Advocates has attained a particular level of skill or ability. This material prepared by Wealth Advocates is for informational purposes only. It is not intended to serve as a substitute for personalized investment advice or as a recommendation or solicitation of any particular security, strategy, or investment product. Opinions expressed by Wealth Advocates are based on economic or market conditions at the time this material was written. Facts presented have been obtained by sources believed to be reliable. Wealth Advocates, however, cannot guarantee the accuracy or completeness of such information, and certain information presented here may have been condensed or summarized from its original source. Wealth Advocates does not provide tax or legal advice, and nothing contained in these materials should be taken as tax or legal advice. Please consult with your tax professional regarding your particular situation before implementing any strategies discussed. Advisory services are only offered to clients or prospective clients where Strategic Advocates and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Strategic Advocates unless a client service agreement is in place. Strategic Advocates LLC is a registered investment advisor. Please visit our websites at www.wealth-advocates.com or www.strati.co for important disclosures. Securities offered through registered representatives of Creative One Securities, a broker/dealer, member FINRA/SIPC. Advisory services offered through Strategic Advocates LLC, a registered investment advisor. Strategic Advocates LLC, Wealth Advocates, and Creative One Securities are separate entities. Wealth Advocates is located at 255 South Main Street, Suite 140, Logan, Utah, 84321.